Hello everyone, I'm back with a new video. The major indices have lost some steam since the start of August after a standout rally through the first 7 months of 2023. Apple has dropped by about 9% since the 1st of August. Nvidia fell by a massive 12%. Tesla declined by roughly 7%, Meta decreased by about 6.5%, and the list goes on. If the current rate of decline continues into the traditional bearish month of September, the stock market could be in danger of falling into a correction, which means a 10% decline or greater from its recent top. But will this pullback really continue into next month? What are the telltale signs investors should look out for? Meanwhile, while I was away for the last 2 weeks, I have bought some shares and opened a few option trades. Specifically for viewers who are interested in my option trades, I have lots of updates for you, about 6 trades to discuss, so do stay tuned to find out more. The S&P 500 and Nasdaq declined last week as both marked their second consecutive losing week. It may not sound too alarming, but interestingly, this is something that we have not seen for the tech-heavy Nasdaq for the entire 2023. The recent pullbacks, in my view, can be attributed to some mixed economic reports, which create some level of uncertainty. And when there are uncertainties, investors will lose confidence. And when investors lack confidence, chances are they may not buy or invest aggressively, and some may even start taking profits. As a result, the stock market declined. Here's an example of mixed economic reports. July's CPI data came in softer than anticipated on a year-over-year basis. That's good news. But the core CPI reading showed some signs of stickiness. Core CPI, which excludes the volatile food and energy costs, rose 4.7% from the prior year. That's still quite high. And then July's PPI data, which was released last Friday, came in slightly higher than analysts' expectation. Though the increase was modest, which was only 0.1%, it may still give investors the uncertainty as to whether the Federal Reserve will increase more rate to lower the sticky inflation to their 2% target. In terms of market outlook, as mentioned in my previous video, the months of August and September are typically bearish because historically, the performance throughout these 2 months haven't been that great. Since 1950, when the S&P 500 has risen more than 17.5% heading into August, the month has been lower 8 out of 11 times and down an average of negative 1.1%. And I don't know why, but somehow some negative news started to surface since the start of the month, with the US government and domestic banks got their ratings downgraded one after another. Market manipulation? I really don't know. But putting these downgrades aside, I don't think it's difficult to accept the recent pullback and weakness because the market has been rallying for a good first half of 2023. At this very point, I would urge investors to be more cautious, at least for August and September. Keep an eye on key support levels on the technical charts amid the current pullbacks, and in the coming weeks, pay attention to various news that may pop up with the intention to bring the market down. I know it may seem speculative and I try not to speculate anything, so I would say again the gist is, stay cautious in the very near term as it may be a little choppy and more volatile than the first 6 months of the year. Don't be alarmed if the selling pressure continues. Moving over to the technical analysis segment, SPY aka S&P 500 is finally having a more significant pullback, as you can see that it broke out from this uptrend channel, came back to retest, failed the retest, and went back into the channel instead of bouncing up. This is bearish, at least in the short term, marked by that mini downtrend channel. Come this week, I think we can expect SPY to fill that tiny little gap at around 443, followed by testing the 50 moving average at around 442. Together with the 23.6% Fibonacci retracement level, it formed a crucial support area, which is 440 to 442. Okay, just to be clear, SPY don't really have to bounce off this area to stop the bearish trend. I mean, it can chop around this range, but very importantly, this area has to hold. Because if we break below this area, we may just head towards sub 430, with the next support at 428. If you zoom out of the chart, SPY does have room to fall as the bottom end of this uptrend channel is at around 420. And guess what? This 420 is a level that I have been talking about for many months. It's almost like a pivotal level for bulls and the bears. Above it, bulls are in control. Below it, bears then have the upper hand. By the way, just to clarify, when I say there is room to fall, it does not mean it will fall. I am saying even if it falls to the bottom end of the channel, we are technically still in an uptrend. Bulls should only panic if it falls below 420 and falls below that bottom uptrend line. In terms of the upside, very simple. SPY has to break out of this mini downtrend channel, then it's considered slightly bullish, just slightly only. Next, it has to break out of the green uptrend channel. If it does, then it's moderately bullish. To be really bullish, it has to do what it failed to do recently, and that is to break out of the uptrend channel, retrace back to retest the top uptrend line, bounces off it, and closes above it. That's when we will have a high probability of creating a new 52-week high as well as all-time high, which will bring us above 468. Let's move on to Apple's chart. Wow, 7 red candles over the last 9 trading days. It's a rare scene for the most valuable US company. That was why I saw a cash secured put option on Apple. More on that later, okay? Meanwhile, since Apple gapped down after it reported its earnings, it looks pretty weak as it has breached both the 20 and 50 moving averages. And it is currently holding on to this 177 crucial support level for its dear life. Come this week, watch this level very carefully. We could just hit down a little to fill that gap between 175 to 176 before bouncing up. But, if Apple finally gave way, we could slide all the way to 170 before finding the next support. When we hit this 170 level, there is then a high chance for us to fill that huge gap between 166 to 170. At this range, I do think it presents a good opportunity for me to dip in a little bit. Not financial advice, of course. On the upside, bulls do have some work to do. First of all, they need to reclaim 181 and 185. Even if they do so, the trend hasn't turned back to bullish yet. They will have to reclaim that 50 moving average, fill that big gap down, then we can say that the short-term downtrend has reversed. When that happens, it will bring us back to around sub 190 range. Okay, here's my personal view. In the near 1 to 2 weeks, it's quite unlikely for this to happen because Apple rarely makes such huge movement in the short time frame, unless due to certain catalysts such as earnings day or CPI data. As you can see, Apple took about 2 months to climb from around 178 to close to 200, but just 6 trading days to fall back down to 177. That's like taking the stairs up, but the elevator down. So, if Apple has a low probability of jumping up so fast in the near term, maybe, just maybe, one can consider selling covered call. Again, not financial advice. Moving over to Tesla, just like Apple, Tesla has fallen back to where it was about 2 months ago. It basically jumped from 240's range to around 300 and fell back down to 240's range again. Right now, it's not looking good because we have one candle below the 243 support level, and it is in this very well-defined short-term downtrend channel marked by the 2 blue dotted lines. For this week, I think there is a chance for Tesla to fill that gap between 235 to 238. In fact, the gap was used to be from 235 to 240, and Tesla has filled it a little bit last week. So don't be surprised if it drops further this week to fill it completely. But whether it bounces up from the gap, it's tough to predict. If it doesn't, the next support is at around 226, which does not look too strong to me. The more critical and stronger level will only come in at 208. Please note that this 208 is actually a very important support level, because when you zoom out of the chart, you will see that this area has always acted as either a support or resistance level. Furthermore, being the 61.8% Fibonacci retracement level makes it even more important than other levels. Okay, before we talk about the potential upside, hello people, there are about 65% of you who have watched my videos in the last 28 days but have not subscribed to my channel. If you found my content useful, I really hope you could help me hit 1000 subscribers by the end of the year. It's just a very small goal as compared to many big channels out there. Your subscription will keep me going. Meanwhile, you can also consider supporting the channel by using my referral links below to sign up for Weibo, YouTube, Tiger, etc. at zero cost. or you can also consider buying me a coffee via my coffee page, but this will cost you $4. Do it only if you can afford, alright? Alright, back to business. For Tesla to change its short-term bearish trend, it needs to break out of that short-term downtrend channel. To be more convincing, other than breaking out of it, it needs to punch through the 255 resistance level. When that happens, then yes, we can say there is a temporary reversal in the short-term bearish trend for Tesla. But for it to be really bullish, it has to go above 264 resistance level and break free from this long-term downtrend line. Alright, let's now cover Google's technical analysis. Google has once again entered a mini consolidation zone since it had that gap up in end July. It basically has been trading between 127 and 133 for the last 13 trading days. I actually shared before that Google likes to go into this consolidation mode. I mean, you can zoom out the chart and you will realize there were so many times when Google was just in its own world of consolidation. And usually after a round of consolidation, it has been followed by a huge move. But whether it goes up or down, it's anyone's guess because it has done both ways before. On the downside, the huge gap will definitely act as a magnet trying to pull Google down. So if the big movement is towards the downside, I think we will easily take out that 2 Fibonacci retracement levels at 126 and 124. The latter, which is around 124-125, should offer some form of support, as that is where the 50 moving average sits. If that does not hold, then we can look towards filling the entire gap and even testing the 61.8 Fibonacci level at 122. Even at this level, it is still not a concern yet. As long as we stay above that purple downtrend line, we are fine. I mean, the bulls are fine. But if Google decides to moon, it has to take out the 133 resistance level. That will then give us a high chance of filling that gap at the top between 139 to 140. A small resistance level may come in at around 138. At 138, it's all about momentum already. Good momentum will definitely bring it to the gap area or beyond. Don't forget, many big tech stocks have created new 52-week high, but Google hasn't. So yup, if we hit 140, I think sellers will dry up and buyers will have lots of momentum at that level. Alright, moving over to the option trading segment, quite a number of trades to update since I was away for 2 weeks. First up, it was this cash secure put on Google that expired worthless on 4th of August, and I got to keep the full premium of $125. This trade was sold on 30th June and the premium was not too bad given the low strike price. Do check out the video on top if you wish to find out the rationale behind this trade. The second trade to update is this Google covered call. It's a trade that I have been rolling and rolling. If you have been following my videos, you will definitely know about this trade. Anyway, I managed to roll the previous contract which was expiring on 4th August with a strike price of 116 to a new strike price of 117.5 and a new expiration date of 15 September. I also managed to do it with a credit. So if this contract expires worthless, my trade will be positive. The third trade to update is this covered call on Tesla, which was sold on 14 July. In case you don't know, covered call is a slightly bearish move. During the period when I sold this call contract, Tesla was at 280s range and was slightly extended. And guess what? About 4 days after I sold this contract, Tesla came crashing down from around 300 to 260s range. If Tesla does not rocket above 385 by this Friday 18 August, I will get to keep the full premium. Once again, more information on this trade can be found in the video link at the top. The next 3 trades are new positions that I opened when I was away. The first one is this cash secure put on Tesla that was sold on 4th August. I sold this put because since Tesla came falling down from near 300, it has been consolidating between 250s to 260s range. It was only last week it started to touch 240s. Therefore, in my view, Tesla may be a little weak now, but it is still in this consolidation phase. And once again, I have shared that consolidation is good for option sellers. Furthermore, my take is that 210 is not bad of a strike price because it's slightly above the crucial 61.8% Fibonacci support level, which sits at 208.5. And on a shorter time frame, this strike price is near the 150% Fibonacci retracement level, which is 211. And to be honest, when I saw the put contract, Tesla was floating above the Ichimoku cloud and in oversold level for RSI for 2 weeks, so I thought it may potentially bounce up. But sadly it didn't, as it fell from 250's range to 240's range. So yep, I don't just show you the analysis that went right, I am also sharing the analysis that did not turn out as how I thought it would be. Anyway, we still have some time till expiration, so let's see how this trade goes. The next new trade that I opened is this cash secure put on Microsoft. Yes, Microsoft, something new, huh? It's my first option trade on Microsoft actually. This trade was opened on 4th August with a strike price of $300, expiring 15th September. The reason why I traded Microsoft this time is because Microsoft has been very resilient the entire year and I have been waiting to trade it. Anyway, check out the chart. You will be able to see that Microsoft has been in this downtrend channel since it reported its earnings. And on 4th August, I saw Microsoft testing this top end of the channel and was sitting at this support area of 328 to 331 range. So I decided to step in. But remember, I always say, for confirmation, one should wait for about 2 to 3 candles out of the downtrend channel. Then we can say it's bullish. I didn't wait for that to happen mainly because Microsoft implied volatility is quite low. So if it really broke out of the downtrend channel decisively, the premium will be very low by then. Looking at the chart again, we can see that Microsoft hasn't been able to break out of the downtrend channel, and in fact, it has gone a little lower as compared to the day I opened this trade. But am I concerned? Not really yet. Because despite falling, Microsoft has somehow squeezed itself out of the downtrend channel, and if we can reclaim that 331 Fibonacci level, it will be slightly bullish. The worst case scenario is Microsoft falls back into the channel and even goes towards the lower end of the channel, which is around 303 to 305. Before that, we still have the crucial 61.8 Fibonacci retracement support level, which is around 310. Therefore, I would say there is still some buffer or protection before my strike price gets breached. Okay, the last new trade that I opened is this cash secure put on Apple with a strike price of 165 expiring 15th September. I sold it on 8 August, which is about 2 to 3 days later since Apple plummeted after it reported its earnings. Before this video gets too long, very quickly, as you can see, there are multiple support levels below, namely at 177, 169 and at around 164. Therefore, I am of the view that 165 is not too bad of a strike price. More importantly, when I sold that contract, Apple actually fell completely out of the bottom end of the Bollinger Band for 3 days. That's a very rare scene, which gives us some probability that Apple will go back into the B band soon, which it eventually did. Furthermore, I think people are overreacting to Apple's earnings. Anyway, if you are keen to check out the Excel sheet that I use to track my option trades, you can download it for free on my Ko-fi page. And for those who are interested in my real trades from 2022, you can consider buying it from my Ko-fi page too. In the file, you will be able to see the stocks that I have traded, their days to expiration, strike prices, whether the trades have expired, closed or rolled, etc. Okay, some end thoughts for this video. Last 2 weeks have been a rocky patch for the stock market. I mean, by now we all can see that there is a bit of selling pressure in the stock market as the 2023's rally started to lose some steam. Investor sentiment seems to have soured given the decline in the last 2 weeks. This decline and the recent volatility showed a sharp contrast with the atmosphere for the first half of the year. Prior to the recent pullback, the market consensus was on optimistic predictions that the Federal Reserve was on track to achieve a soft landing. As the economy and job market remained strong and resilient, many investors were getting a bit ahead of themselves. So right now, I think it's quite a bit of a reality check as we started to see some inconsistencies in the economic reports. As mentioned earlier in my video, mixed results or economic data create worries in the market because investors may think that the Federal Reserve's work on bringing inflation down isn't done yet, and they are guessing again whether will Fed introduce another round of rate hike in September. It basically generates this level of uncertainty, which then increases the likelihood of volatility ahead. Okay, enough of the negative portion. Some positive takeaway from the ongoing pullback is that some good companies saw their share price pull back to key levels, and some are even having a mini consolidation period. This means what? This means buying opportunities. Not dishing out any financial advice here, but personally I have bought Apple and Microsoft over the last 2 weeks, and prior to this I have bought Tesla. I will continue to watch these stocks that I want to buy in the next few weeks. If you are interested in what are the stocks that made up my main portfolio, you can check out this video that I did last year. Link can be found at the top. I'm so glad that all these stocks that I have mentioned have rallied quite hard this year. Another positive note is that though S&P 500 and Nasdaq have been falling, Dow Jones has been climbing. And despite the tech industry losing steam, many other sectors are looking fine or even catching up in the last 1 month, such as the banking industry, retail industry, pharmaceutical and healthcare industries. As previously shared, this is a good sign because in the solid bull market, we need to have more breadth in the rally. Alright, that's all for this video. Do you have a watch list of stocks that you are preparing to buy? Can you share with me in the comment section below? And before you exit, please don't forget to hit the like and subscribe buttons. Thank you.